Well, the S&P 500's rally from the March 2009 lows now stands at 77%. Our next guest says that was the easy part. Jeffrey Coons is the co-director of research at Manning Napier Advisors. He oversees investment strategy at the firm's funds, and he joins us here on set. Welcome to Bloomberg News. Thanks so much for joining us.
Thank you for inviting me.
You think the picture now is going to be mixed. Why?
Well, we have indicators that were universally favorable a year ago that are now showing more of a mixed signals. We're seeing valuations that are not quite as compelling as they were. Sentiment has gotten a little bit complacent. There's a little more optimism than there was before. And that wall of worry seems to have come down somewhat. And as a result of that, it's going to be more difficult to achieve returns.
And there's always that question of liquidity. There's still an awful lot of money on the sidelines, right?
There is. That's a positive that a lot of investors have not yet stepped in and started buying. We've also seen a few other positives in terms of the leading economic indicators are still strong. There are some good things going on, but at the same time, it's not as compellingly positive as it was a year ago when there was so much worry, so much fear that you knew you could buy the best companies and you weren't paying too much for them.
So, Jeff, it sounds like you're painting a scenario where, you know, it'll be a bumpy ride. There still might be some increases. Do you think there's a chance of a larger pullback at this point in time? Are the risks that grave that we would see something like that happen?
I think there's certainly risk of volatility, and volatility has become much less severe over the last few months and weeks, and we would expect there to be a little more volatility going forward. But I think more importantly, this is an opportunity to look at different industries or companies and their economics, spend less time thinking about the overall market and more about how these companies are positioned and how much you're paying for them.
And one of those areas you're looking at, airlines. Now, obviously there's been a lot of talk of consolidation recently. You would think that given that the consolidation is sort of already known about. I mean, but why look at airlines then?
Well, we still haven't seen a pickup in demand, and yet you're seeing full planes. The average seat miles are increasing for the individual airlines. You're seeing market share gains for those that are surviving, and that really is a positive even before demand picks up. You get enough of a contraction in supply and enough reduction in flights, and that's going to help improve return on investment. Ultimately, that's going to be a good thing.
Jeff, could I ask you, a lot of has been made about the economic stimulus. Where would we be without it, in your opinion?
Right. Well, this would be a very difficult environment without it, and the first half of 2010 is being driven in some ways by that stimulus as well as some good comparisons year over year. I think the second half of this year we're going to find out because stimulus is going to have much less of an impact going forward.
So we'll see if it can stand on its own at that point?
And it's going to be a difficult ride there. So there are a lot of positive short-term factors helping the economy they're going to go away in the second half.
To go back to the airlines for just a second here, how big of a problem do you think it's going to be that fuel costs are starting to go up once again?
Right, and higher fuel costs begin to squeeze the weaker competitors. It'll cause more flight reductions for those competitors. The real opportunity is for the low-cost carriers, the Southwest Airlines, JetBlues, those types of airlines that have lower costs and can gain market share while some of the legacy carriers have a tough go with higher fuel costs.
What about market segments? What are you liking?
So, you know, there are specific industries that we like and sectors in healthcare and technology where there's growth potential that is not yet.
Did you see that growth potential before the healthcare reform package, or was it still a little bit up in the air? How have they been responding to that?
Right. Well, you've seen a little bit of a move since the reform package, but the companies we like are the ones that are well positioned for higher R&D spending, higher, you know, increased service and improved profitability.
Yeah. We can see on our screen that healthcare index on the rise as well.
Right, yes. So those are the type of companies you want to see, not just ones that benefit from reform, but generally ones that are well positioned to grow.
I have to go back to technology. We have so many people who like technology right now. I feel like every investor we talk to, and yet they may like it, but I don't know who's buying it because the group is not up that much for the year to date, even though earnings have beat estimates, sure, over the last year, but that's less than the market. That's an underperformance of the market, that 48%. Why has that happened, and what is it going to take for these guys to finally start catching up?
Right. Well, we saw a very strong second half of last year for technology, and the first quarter we've seen tech stocks lag a little bit. When it comes down to it, a lot of these companies individually have great growth potential, and you're really not seeing that premium valuation to these companies at all. We're beginning to see more capital spending is going into the hardware side, and eventually you're going to see it move to the software side. We think that the companies positioned in software are very attractive right now and should get good returns, but we expect 2010 second half and beyond will be where you see the growth from software.
All right, Jeffrey Coons, co-director of research, joining us today from Manning and Napier Advisors. Jeff, thanks so much. Appreciate it.
Thank you.